Welcome to the Bulletproof Cash Flow Podcast, the go-to place to gain financial freedom through real estate investing. Here we interview investors, mentors, and entrepreneurs who share their secrets and advice to help you build passive income. Let's get into the show.
Hey everyone, this is Augustino. Getting into a bad deal is something we obviously don't do intentionally, but for many of us starting out, it does happen. Today, we'll explore overcoming challenging situations in multifamily deals, and more importantly, what to do with the situation after it happens, and then also reflecting on those lessons learned. Well, our guest has many words of wisdom as his companies manage well over $200 million in assets comprising of nearly 3,500 units. Since 2015, he has raised nearly $60 million in equity, acquired over 2,500 units of his own company, Barratt Asset Management, and he's built this company to a best-in-class, vertically integrated asset property management firm. I'm very, very excited to be digging into some life lessons here with our guest, Ivan Barratt. Ivan, thanks for coming on. I greatly appreciate it, man.
Hey, thanks, Augustino. It's great for being here. I'm excited to have a conversation today with you, man. It's great to be on your show. Thank you.
So before we go on, if you like what Ivan has to say, you can check out his website at ivanbarratteducation.com. We'll include the link in the show notes as well. So, okay, Ivan, maybe go ahead and tell the listeners about how you got your start.
Sure. So I was pretty lucky. My father is an attorney here in Indianapolis, Indiana, and I grew up with him owning several rental properties. He had a bunch of duplexes. Never got beyond that. But one of my favorite running jokes is when I was 7, you couldn't have your father arrested for forcing you to perform manual labor all summer long as his landscaping operation. So my brother and I got an early taste of it in a manual labor sort of job. And then from there, it did plant a seed. All that manual labor motivated me to get educated, get a higher education. So I went to school and decided to actually major in real estate at Indiana University. Their finance school actually had a small real estate group inside that. It was very unpopular at the time. Most kids were getting into the technology side of thing. It was right before .com burst back in 2001. And so I thought, hey, real estate would be a great way to sit around and watch all those great rent checks come in and not have to get a real job. Of course, it turns out it is a real job, but I do enjoy it. It does offer a lot of advantages. Got out of school and got my foot in the door with a developer, one of my first major mentors. Still almost like a father figure in my life today, behind my dad. And take him out to lunch at least once a year. Anytime I can get on his schedule, I'll buy him lunch. But worked for him for about 8 years and got a really well-rounded education in real estate, and was really fortunate that a young, cocky, arrogant kid that thought real estate was really easy, I got a front row seat to 2008 without being super exposed to it. Did end up being a couple $100,000 in debt, at the time seemed like an insurmountable amount of money, but was able to crawl my way out of it, pay it all off, start my management company in 2010. And I started this whole thing by managing properties for other people. Basically anything I could get my hands on where I didn't have to carry a gun. Started off with really, B assets, small duplex townhomes, lots of condos that people couldn't sell back then. Just basically anything that I could get my hands on that I could start growing a management company. Did it all myself in the beginning. Worked harder than smarter really for a while, and then started figuring out how to scale it, how to grow it, and slowly and surely we've grown from there to, as you mentioned today, we're north of 200 million in assets under management. We no longer really do the small stuff. We focus on what we call site managed multifamily, which is where you've got on-site staff at a 150 to 300 unit community.
Nice. Excellent. So maybe you could tell us a little bit about one of your earlier deals. What would you actually start off with? What would you say is your most challenging early deal?
Yeah, so I started off, I house hacked a duplex right out of college. Basically, my dad said, hey, I'll match your down payment if you live at home and save up to buy a duplex instead of renting an apartment. And I thought, okay, whatever, why not? Because I didn't want to be a landlord back then. I thought I would be developing, building things and selling them. and sort of forgot about income property. But I did manage to get a duplex, and then really didn't buy anything else until the crash. Those years when I was focused on development, it was a real major distraction, actually. I learned a lot, but it was all about, building projects, developing land, and selling that project. And of course, when the crash hit, it forced me to do some soul searching and really focus in on why I got into real estate in the first place, which was cash flow. And so from there, in addition to getting little management deals from clients and working on getting more, I was able to get my hands on my next 2 duplexes, getting some seller financing. And then I figured out from there, actually through a little course I bought on flipping foreclosures, I actually found a formula in there that worked really well for using hard money and what Bigger Pockets refers to as the Burr method today. Of course, it hadn't been coined the Burr method yet, but bought a 3-unit, very run down, but in a nice area, used all hard money, almost no money out of my pocket to renovate it, get it leased up. And then, of course, instead of flipping it, I refinanced it with the bank. Did the same thing several more times. I did that on my first big apartment deal, which was 6 whole units. That was a big jump for me. And then from there, really started focusing more on apartments. My first, major deal was 35 units. The next one was 30. Said I'd never buy a small deal again, and I bought 15 because I couldn't pass it up. And then the last deal that wasn't big enough for on-site staff was 60 units. And then from there, I bought my first 112 unit deal and never really looked back. Now we own 250 unit deals, 300 unit deals, and we're typically buying assets somewhere between 15 and 34 million.
These are all in your backyard then? These are all in Indy, in and around Indy?
As we've grown, we've become much more geographically flexible. So we're in Indiana, Ohio, and Illinois now. And of course, the farther out we go, the bigger the deal typically has to be, or at least minimum size, so that we've got really good staff that we can put in place when we close, because we are a property management company first. We want to be able to control the assets, and we want to be able to control the business plan. So everybody's in-house: management, maintenance, construction, management, CapEx, all that accounting and compliance and asset management that goes along with that.
Let's talk a little bit about those first bigger units. Those 30, 35, I think it was a 30, a 35 or 36, right?
Yeah, so the 35 unit was an awful deal. I thought it was a good deal when I bought it. C- property. I bought it from somebody I knew. He had some issues with it, but I thought I could turn it around and get better residents, make some improvements. It really proved that I didn't know what I was doing yet. And I sort of knew that. And for me, at the time, I had one partner who's a good buddy of mine. He's still a partner today. But we both sort of agreed, listen, we're going to make some mistakes here, but we'll learn from them and we'll move on. And I'm happy to expand on that particular deal, because everything that could have gone wrong on a project went wrong on that deal.
So starting right from the top, what was your first mistake? What would you say was your first mistake on that?
Oh, first mistake was I paid too much for it. 35 units. At the time, I think I got it on like an 11 cap, and it was like a C- property at best. It should have been like a 15 cap when I bought it. I mean, there was just so much wrong with it. Rough tenants. It was an area I thought was going to turn around. The area didn't turn around, at least not as fast as I thought it would. And brand new boilers within the last 5 years that the guy owned it. And he didn't know it, and I didn't know it at the time, but he used a less than honest company, and they put in some pretty shoddy equipment, and it was installed improperly, and I didn't have the right guy to maintain it, and I thought I did. And we ended up replacing all 3 boilers over those next 5 years that I owned it. Sewer line collapses, drugs, homeless people in the laundry room. You name it, man. Wow. You name it. I went through it. What saved me was having the management company in-house. The last couple of years, I really wasn't charging myself too much in management fees.
Yeah.
So the management company was able to eat a small loss on that deal until we could get it turned around. Finally got the right management team in there, got it stabilized, occupied, got some good paying tenants in there, got rid of the bed bugs. And at least last time I checked, And we're able to sell it to a guy that really specializes in that type of property, and he's happy with it. Over that 5 years, we were able to return a 9% IRR on our cash invested, which for everything that went wrong,
That's not terrible.
yeah, for everything that went wrong, we're pretty happy with the result.
Right.
And I can't claim credit for all of that. Some of that's just being in a good market and knowing when to sell.
Yeah. That was an indie.
Yeah, that was in an area in Indy called Beach Grove.
Oh, Beach Grove. Yes. I know Beach Grove. Yes.
Yeah, so I thought Beach Grove was going to be the next Speedway, which is the other side of town where the Indianapolis Motor Speedway is. It's a small town that got surrounded by Indy. And I thought the little Beach Grove area was going to start to turn around. And I was 100% incorrect.
Yes. Sorry about that.
Hey, you live and you learn. Now we have a deal in Speedway, and we love being in over there.
Yes. Well, it's funny because there's a deal that my partner and I just did. We actually dug up some information from the city. It's actually in the path of progress. The city actually plans on renovating that whole street. And we found that actually after the fact, after we actually put the offer in on the deal, like shortly after we found out. Yeah, it's beautiful. Beautiful. Yeah. I don't even think the sellers are aware of it. So those are the types of deals I love to do. It's like you see the path of progress, but it gets validated by an actual document by the city. So there's ways of checking that stuff out before you buy as well, right? Or before you actually get in on it. Yeah, absolutely. So now are you finding that you're automating a lot of your property management into systems and tech? Are you actually doing anything like that? Or is it still largely a people side of the business? You know what I mean?
Yeah, no, the answer to your question is yes. Our mission is to find great people and to be a company that people are banging down our door because they want to work here. But the other side of that equation is you have to give them the best tools and technology possible to help them do their jobs as best as possible. So we're keenly focused on automating systems, using the right software, giving our team the right tools to make them more effective.
Yeah, I mean, I'm only asking because there are many landlording systems that are sold out there in the market, right?
Yeah, a lot more than there used to be.
Yeah, that's right. Some of them are really good. Some of them are not so good. But to have those types of systems integrated into, say, a property management system like AppFolio, there'd be some automation there in terms of handling interactions between the tenants and serving their needs. For instance, here's an example. Sending out automated birthday cards, automated text messages for things like that. I think that basic stuff already happens today, right?
Yeah, we're testing out some new software pieces that will make maintenance a little bit more interactive for the resident experience. We are on AppFolio currently. I could see us within the next year or so, maybe upgrading that platform to some of the more institutional grade, the Yardys and the One Sides of the world as we continue to grow the company and the platform.
Yes, only because there's one of the things that I often get caught up with is handling evictions, right? And I don't handle them myself. My attorney does that, but putting in some automation there that if the tenant goes 3 days before you send them the 3-day notice, maybe on day 2, you're sending them an email with, here's some help for you. You go to these 4 different places if you need help, to make your rent payment or buy yourself some food or whatever, build some automation around that.
Yeah, I couldn't agree more. That proactive approach, that personal touch, giving people information on where they might be able to get help and that sort of thing, that's definitely a growing trend in the business, especially the bigger companies are even doing that now. And it's almost like a hospitality business where the multifamily industry is becoming way more resident-centric than it used to be.
Yeah, way more sophisticated. Absolutely. Now, you mentioned partners, right? So you're still working with that partner, the same partner today, you said, right? In this 35 unit?
Yeah, he's one of my limited partners.
Okay.
He's a little bit more communicative and active, but he's still technically a limited partner. Former real estate guy, young guy, has a lot of cash, doesn't like the stock market. So he's one of my LPs, which now we're up to, with our last acquisition, actually last week, we're up to over 100 limited partners, and about 60 of them have done at least 2 projects with me, 2 investments. I've got an active business partner that runs the day-to-day operation of the business, especially on the management side and the deal flow side. And we've been partners now for about 3.5 years.
That's Adam, you said, right? At the beginning, in the green room you
Correct.
mentioned.
Yeah, Adam, the yin to my yang.
Yes. Well, you know what, though? I think something you touched on earlier was management. Management is what ultimately saved the day, it sounded like, in that 35-unit disaster, right?
Yeah, every deal that hasn't gone according to plan and you're already in it, you can't just turn around and sell it for a loss. You could, but you don't want to. Management's been absolutely the saving grace. A couple of my early deals, management's absolutely what saved us when there wasn't enough cash necessarily to distribute or to go around on those early projects. We could eat that management fee for a while in order to keep the project going, instead of having to do a capital call. Now I'm the dumbest guy in the room when it comes to property management, and Adam makes sure that I stay out of the management team's way so I don't screw anything up.
But you know what, though? See, there's value in finding people like that, right? Like, how do you find them? How do you find those great partners that you can actually lean on and depend on? And how do you keep them there?
Yeah, the first answer to that is I would refer to it as tinkering. If you're going to be an entrepreneur and you're going to be an operator and you're going to grow a real estate business, you're going to make mistakes. Your goal should be to make as many mistakes as you can early, because the sooner you make them and learn from them, the less they cost you. And so I went through some people. We were joking about this the other day. I think the shortest stay here at BAM, this is a few years ago now, it's a different culture here, but I think they lasted like 3 days.
Wow.
Early on, I would get to this point where in order to grow again, I had to fire, key people that weren't ready to grow with the company. And now we've got this great executive team. They've got so much growth in front of them. They work hard. They each have autonomy in their respective part of the business. And they still make mistakes and they still have to learn from those mistakes. But those mistakes have more of a return on investment because as those members of the executive team grow and learn, right, they pass on that knowledge and they develop as leaders and they develop more leaders underneath them. Whereas earlier on, small little, 2-room office, you're just hiring anybody that you can get your hands on because you just, you need the help.
That's right.
Now we've got a much nicer culture that tends to attract great people rather than us having to go out and scour the earth for them.
Yes. Now, to contrast that 35-unit disaster versus what you're doing today, what sort of lessons are you extrapolating in terms of the ways that you're underwriting a deal today versus how you did it before? I'm assuming now it isn't just you that's doing it. You must have other people that help you with it, right?
Yes, I typically don't get involved in the acquisition pipeline until it's about halfway through, until we think we've actually got a deal. Other people on the team are responsible for underwriting all those projects because we're underwriting 200 offerings to find one. We're kissing 200 toads to find that one princess. And then now, at this stage in the cycle, as late as we are, probably not going to be chasing any C properties for a while. We're looking more into the B+, A- category, probably closer to that $30 million mark than $15 million. The air's a little thinner up there. It tends to weed out some of the smaller players bidding up prices. And we're looking at assets that we don't mind holding for 10 years. So we're looking for newer, nicer. We still want some sort of value add play. We're still looking for management efficiencies and the ability to raise rents through renovations. But we're capping our upside. Right now we're only looking for a 16, 17, 18 IRR. We're not looking for those big pops. At the same time, though, we're greatly reducing our downside risk. We're looking at deals that might have lower leverage, or they might have agency or HUD debt in place when we buy, or shortly thereafter, taking interest rate risk off the table. Our first rule is don't lose money. Our second rule is remember rule number 1. And number 3, we're looking for how do we get a solid yield, net return, north of 15% to our LPs.
So it's interesting when you are going up market. Then with those A-, B+, you're not going to do as well, I guess, as far as returns are concerned with those C's, right? Obviously, I mean, So just because the risk is less in those alternate classes, those better classes, right? Just to clarify for the audience.
Yeah, and the problem with C properties, at least in the Midwest, is they're being bid up so much to where the returns are coming down to where a return on a B plus, A minus asset might be.
Absolutely.
All things equal, I want to buy a B plus or an A minus at the same rate of return and not take the C minus to a C plus or C plus to a B minus execution risk that exists in that model.
Yeah, absolutely. I mean, here in Ohio, that's where I'm at. Same thing is happening here. They're bidding up some of these properties. It's just insane. Some of these C-class properties hitting $50K a door is just nuts.
Yeah. There'll be some opportunities for us down the road a little bit.
Yes, there will be. I know there will be. So let's transition over to mindset now. And we talked a little bit about this in the green room as well, as far as like mastermind groups and training and that kind of thing. So have you done any types of mastermind groups, or are you doing them now that's really changed your outlook on business and life? Tell me about those.
Yeah, absolutely. I'm a huge mastermind guy. My dad had every tape course under the sun. So I grew up listening to Earl Nightingale and Zig Ziglar and some of the greats. I don't read quite as much real estate books now. I read investment analysis every now and then. Economic history is one of my favorite subjects. Most of the time, though, I'm listening to content on mindset. And then I'm in EO, Entrepreneurs Organization. So I'm in what they call a forum here in my hometown with 6 other entrepreneurs. And we're all in different businesses and we're in a mastermind together. And we get a lot out of that in that we can more freely share being in different operating companies. I've actually received so much value, so grateful for some of the tactical information and ideas I've received from entrepreneurs that aren't in real estate and far from it. And then I'm in a real estate mastermind also through EO, which are a bunch of entrepreneurs up and down the Eastern Seaboard, from Canada to South Florida. Rod Khleif asked me to be in a mastermind. I couldn't make the last one, but I'm excited to be in the next one. And then I'm actually in a couple other smaller ones that aren't real estate related either. I think you can get a lot out of both.
Yeah.
But in any business or whatever path you're going to take, having those like-minded people around you, having a strict format you're following for accountability, for sharing information, for sharing experience, there's so much value. I've got an easily 100x on my membership in EO. And then I have a business coach. I train with a personal trainer because I'm not going to work out as hard if I don't have a trainer. Just like I'm not going to work out in business as hard if I don't have a coach every week asking me if I did what I'm supposed to do. And I've spent tens of thousands, if not 6 figures, on education, seminars. You know, the way I look at it is if I spend $5,000 and I go to a 3-day event, all I need is one gold nugget out of those 3 days, and it was worth every penny.
That's right. And that's what I tell people too. I mean, I love events out here in Ohio. And, I encourage people, guys, go do that course, spend $1,000. That $1,000 will return at least 10x, at least.
Right. And we didn't even talk about the networking benefits of that either.
Yeah, that's right. You get to meet some really great people.
Yeah. I've always gotten at least one phenomenal relationship out of those types of events.
Yeah, absolutely. There's so many great people that go to those things and you never know, might hit off with somebody. And next thing you know, they're your next business partner.
Yeah.
Yeah. Shouldn't be afraid to spend any money on any types of training, guys. That's the lesson there. So you mentioned you have a personal trainer there. So what sort of tools do you use to maintain your success, outside of your business with your family and everything else that you have going on?
Yeah, EO is one of them, the business coach, certainly on a daily basis. I listen to a lot of self-development in my car. I'm listening to good content. I'm always trying to squeeze in that mindset content. I listen to a lot of sales training. My first sales job was age 16. I've been in business development my whole life, and I still repeatedly listen to that kind of content. And I'm sort of a 10x Grant Cardone disciple. I think he's got a lot of good content there. He gets a little crazy on YouTube every now and then, but I think his courses and his audiobooks are phenomenal.
Yeah, big fan of his as well. Yeah, absolutely.
Yeah.
He's definitely obsessed.
And for me, I have to work out. If I don't work out in the morning, I go crazy. there's so much stress related to this business. If I didn't have an outlet for that, I might hurt somebody.
Are you doing boxing or MMA or something or what?
Oh, no. Just I do CrossFit, and I got a little Peloton bike in the basement, and I ran 4 Spartan races this year, and I'm going to run more of those. Those are a great way to sort of push yourself past your comfort zone, stay motivated, feel accomplished. And when those are coming up, it makes me train harder in the gym because I know I gotta get out there and get across the finish line, which is not easy for a big, slow guy like me.
Hey, the Spartan race is no joke. I did that one time. Is it a 14.2 mile? I think it was. Yeah.
Oh man, you went straight for the beast mode.
I did. Went straight for the beast mode. Won't do it again.
I like you. That's awesome, man.
Yeah, it's good. It's good. So in terms of sacrifices though, I really do believe that starting out, you're sacrificing a bit to look out for the long term, right? Have you have to do a lot of that tough stuff or what?
Oh yeah, big time. I am a firm believer that if you want to do what you want to do eventually, like if you want to have that financial freedom, if you want to have that flexibility, travel or family life, whatever it is, you first have to do what you hate. And it's not about this, I got to do what I love. It's like, no, that doesn't work.
Right.
If you want to do what you love later, you got to do what you hate first. I didn't get into property management because I love property management. I love tenants and toilets. I freaking hated it. And if this was an R-rated podcast, I would have put in a different F word right there. But, I knew that I had to figure that out to scale a business that actually generated real income every month was repeatable. Because otherwise you're just going after the next deal, or you got to sell a deal or refinance a deal to make fees. And if the market changes, you can really get screwed. That's what I saw a lot of people going through in 2008. And then managing people early on, before we figured it out, it made real estate look easy. But I had to get through that. I had to learn those lessons the hard way. And it was a lot of sacrifice. When I was managing about 70 units on my own, I mean, there were multiple weekends where my phone would ring and my blood pressure would spike because I knew it was going to be a bad phone call.
Yeah.
Those were tough days, and I hope I don't have to go back there. But if I lost it all and had to start over, that's where I'd start.
But I really don't see another 2008 happening. I mean, that's what the predictions are saying. They're saying that we're not going to get anything that bad. I mean, there will be a correction, but it's not going to be that bad.
Yeah. If you study economic history, the next one should be soft correction. If Ray Dalio is right, though, the stock market's going to take a huge hit, but the economy overall should be okay. I'm in the school of thought that 2008 was an 80-year systemic correction in the cycle, big cycle, 80-year cycle, similar to 1929, although the Fed did a better job with it this time. Yeah, I think the next one will be a lighter version. At least I hope it will be.
Yeah, I think so too. No, I really believe that too. Yeah, absolutely.
There's too much cash on the sidelines. If people think that real estate's going to take, a 20% haircut, or at least multifamily, there's just too much cash on the sidelines. If it goes down 5 or 10%, all that cash will put a floor on pricing pretty quick.
Yep, that's right. So let's discuss maybe surrounding yourself with positive people and how limiting beliefs have really stopped people from achieving their complete goals. I mean, have you ever met those sorts of people? I'm assuming you have with your business. And how have you actually coached them out of those limiting beliefs? Like, how did you help them out of that?
Yes, I run into that all the time. And I try to be a good example. And people that really ask and really want to know, I try to remind them of the guy that I was when I started, right? Because now they see the nice car and the big office with all the employees and the nice house. Typically, a lot of people forget everything it took to get there. They don't remember the Camry I drove for 14 years that, almost fell apart before I got rid of it. They don't remember the house that I used to live in that, my wife and I put off owning the big house for years and squeezed into a much smaller one with our kids, because delaying that gratification allowed us to expand that gratification when we were finally able to. I know I'm getting off what you said though, but yeah, I love doing these podcasts. I love talking to young people and reminding them of how I got started and what I would do today if I was 22. I think there's some really good content out there for the people that really want it. The thing is, what I think is wrong in real estate right now is there's all these kids out there that think that they're gonna be financially free and financially lazy if they get into real estate. And I love seeing guys like you and Jake and Gino and all the other guys saying, listen, this isn't the easy path here. There's a lot of hard work, but if you have the right mindset and you just do those steps every day, almost like if you want a six pack and you got to do sit-ups every day, right? You just do the right little things every day and you forget about 5 years from now, but focus on what you got to do today, tomorrow, the next day. That momentum starts to build up and that time starts to compound positively. But, as you know, what happens is a lot of people, they go out and they get jobs and mortgages and cars and debt, and then they feel more trapped and more limited in their belief system, right? Like they've missed the boat. And those ones I try to remind, Colonel Sanders is probably one of my favorite, not hitting his strike of gold until he was in his 60s.
That's right. That's when when KFC finally hit. He was already well into the fall of his life.
Yeah. And let's face it. I mean, what we do is not rocket science, right? I mean, we're lucky. I think what people mix up is the difference between simple and easy, right? Real estate concepts and creating value and cash flow and being successful in real estate. The rules and the ideas are really simple. It's just anything but easy. It takes really hard work to do it right.
Absolutely right. Let's get into the bullet round. I'm going to ask you a few questions in the bullet round. All right, you ready?
I'm ready as I'll ever be, Augustino. Hit me.
All right. Your 3 most influential books and why?
Okay, so I know everybody gets all the usual answers here, so I'll try to be a little unusual, but I will have to give another shout out to Earl Nightingale. Lead the Field, timeless audio course on being the best. One of my all-time favorites for sure is Anti-Fragile by Nassim Taleb. I think it's a great read, and there's a lot of application to real estate in there. And then number 3, I'm going to give a shout out to Robert Kiyosaki. I got Rich Dad Poor Dad when I was going into college in 1996. Very fortunate to get that book early. But my favorite book he ever wrote, far less popular, I almost never hear anybody talking about it anymore. It was called Conspiracy of the Rich. And that really started my path on learning more about the Federal Reserve, monetary history, monetary power, how empires have risen and fallen, and just all the great history around fiat currency.
Nice. Excellent. I got to check those out.
Yeah.
What do you see the next 5 years looking like for your business?
We're at a point where it's mostly rinse and repeat. We strive to do one thing very, very well, and that formula is workforce housing here in the Midwest with a value add component, analogous to a private equity company going out there and buying businesses. Doing more of that, scaling. Our next step to scale is we're going to be launching a fund in Q1. Now that we're north of 200 million in AUM with a very solid track record since those dark early days. Since 2015, our syndicated assets have done very well. And we'll launch that fund simply because it'll make it much more efficient to go after the larger $30 million deals, $60 million, $100 million portfolios when you've got the dry powder lined up and ready to go.
Yes. Okay. What's your philosophy for life and success? What motivates you?
Oh, man. I'd probably have to pull from 10X. That whole mentality about if you really want to aim high, you got to aim higher than that in order to hit it. And it takes 10 times the effort and 10 times the work than you thought it would. I'd probably mix that in with Christianity and Stoicism. Oftentimes in this business, I repeat to myself, the obstacle is the way, just as almost like a mantra when I'm having a stressful day. And then my family motivates me more than anything. 3 kids and a wife at home motivate me to be a good example and live an abundant 10X life. And that's not just about money. That's about spiritual health, the health of my kids, the health of my marriage.
Excellent. All right, guys. Well, if you want to reach out to Ivan, you can reach him through his company website again at ivanbarratteducation.com. I hope you got a lot of great insight from this. I certainly did. definitely mindset is so important to your success. Thank you for your time, Ivan. I really, really appreciate your time.
It was awesome to be here, Augustine. I loved hanging out with you, man.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast. For more free podcasts, articles, videos, and resources, go to www.bulletproofcashflow.com.